All right, we are gonna be. We just talked about betas, how to calculate it and what it is. Now we're gonna focus a little bit more on this interpretation. Quick recap. Beta here, it can be calculated here by this formula, and we are gonna mainly probably use the formula on the right. And it depends on the correlation of the asset with the market and the standard deviation of the asset and the standard deviation in the market. We calculated on Excel the beta for these four sectors and for the S&P 500. So let's quickly go over a couple of things here. So beta depends on the correlation coefficient that always will be one or less. So even though the relationship between the asset standard deviation and the market, if the asset has the same standard deviation than the market, it still can yield lower than 1 betas, right? Because the correlation coefficient can be lower than 1. And the opposite is also true. If an asset has more risk or more standard deviation than the market portfolio, it can also have beta less than 1 because the correlation between them can be very low, right? So it's very important to look at the ratio between their standard deviation and the correlation coefficient between them. And how to interpret that? If beta is equal 1 over here, it means that the returns follow the market movements, all right? If you think that you are holding the market portfolio, it means that it brings the same risk level as the market. If beta is greater than 1 over here, you can think of an asset that has a beta greater than 1 as an asset that its returns is amplified by market movements, right? It's sensitive to market movements. When markets go up, this asset prices will probably, or returns will probably go even upper. And the opposite is also true. When market crashes or goes down, this asset will fall probably more than the market. And the opposite is also true here. If beta is less than 1, it means that it's less sensible to market movements, right? Or it brings less risk than the market portfolio. If you look at our results here back, we have these 4 sectors and the S&P 500. The S&P 500, we didn't even need to calculate it. It should equal 1 because it's the market. So it will equal 1, it will equal the market because it is the market. We use that as our benchmark. Now food here, for instance, insurance and telecom have beta less than 1. It means that they are less sensitive to market movements than banks, for instance, that probably have its returns very sensitive to market movements. And let's try to do another example here that will probably make it clear for you guys. So what I have here on Yahoo Finance, I have Vanguard 500 Index Fund, which we used as the market, or S&P 500 as the market benchmark. And I plotted here the VFINX here, the fund, which is in blue. We have here this line in lighter blue, which is Best Buy, and we have in pink here General Mills. When you look here at the returns of the market, let's focus here on Best Buy. Marketing is doing good. The market is doing good. Best Buy is doing even better. Like you see that it's very amplified here compared to the market that just goes on a straight line. Market went up a little bit over here. Look at how much went up Best Buy. Now look at a little bit later here. Market went down. Look how much down went Best Buy. Like it followed the market, but its returns were amplified by the market movements, right? So let's keep going. Market, we're doing good again. Ups and downs here, but it's going better than market. Then coronavirus happened here. Market down a little bit here, but look at how much Best Buy dropped. Now the recovery as well. Markets recovered at the rate. Best Buy on a greater rate. So you will see that Best Buy actually has a beta greater than 1. So it's very sensitive to market. On the other hand, let's look at General Mills that produces food goods and utilities, or that maybe fits on a utility, but food basically, the food sector. Markets are doing good. General Mills, it's okay. Markets went down a little bit, then was down. Market went down a little over here. It was a little bit down as well, not as dramatically as Best Buy. Then it went up, recovery. Market went up. General Mills didn't go up as the market did. Then coronavirus happened here. Market went down. Best Buy went down way more, and General Mills didn't go that down, right? So as you would imagine, General Mills has a beta less than 1 here, 0.57, meaning that it's not as sensitive to the market as, for instance, Best Buy here, right? So try to think on beta as how sensitive is the asset to market movements. And finally, just a questions for you guys to think at home. Think on 2 companies here, Procter & Gamble and Tiffany, the luxury good. Which one would you expect to have a higher beta and why, right? So think about it and we'll discuss it later on.